Welcome, 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 everybody, to another Sunday. I was going to say Saturday. Oh boy, we're off tomorrow, so that's why it feels like Saturday. Welcome, welcome to another Sunday of When Black Women Gather. This Sunday, we have the honor of having Kennard Dixon, who's going to talk to us about our financial health and our financial wealth. And please know that this session is being recorded and it will be placed on YouTube. So if you miss something here, you can catch it there later. So for now, I'm going to turn it over to Michelle, who was pleasant that she got Kennard for us. And I encourage that if you all are out and you see somebody who you think would be a good guest, I encourage you to do the same. So on that note, I'm going to turn it over. Please mute all of your sound systems, and any questions that you have, put them in the chats and we'll grab them and do a live Q&A afterwards. So on that note, it's all yours, Miss Michelle.
Thank you, Ms. Higgy. Ladies and gentlemen, it is my pleasure to introduce Mr. Kennard Dixon, a licensed professional in the realm of financial expertise. A few weeks ago, my husband and I had the privilege of attending a financial seminar where we were captivated by his insights. This afternoon, Mr. Dixon will delve into the crucial topic of financial well-being, promising to provide us with invaluable information that is both enlightening and motivating. So let's all prepare to be amazed. Please join me in extending a warm welcome to Mr. Kennard Dixon.
Thank you, Michelle. Thank you. Thank you, guys. As I begin to share my screen, we are going to talk about a few things. Give me 1 second here. We are going to talk about a few different topics this evening. We are going to discuss our healthcare, which is our Medicare. When we talk about our healthcare, we're going to talk about our life insurance, just to make sure that we have adequate life insurance in place. We're also going to talk about the need for long-term care. Having long-term care is very important. We will also discuss finances, guys. We will discuss how to lower your tax brackets, right? We'll lower your tax liabilities, how to dodge Uncle Sam, how to grow wealth without risk, okay? So when we start, we're going to talk about Medicare, starting out, guys. Now, when it comes to Medicare, there are a few key components that we're going to need to pay attention to. We have our Part A, which is our hospital. We have our Part B, which is our medical. And then we have what we call our Part D. And D is for your prescription drugs. Okay? Now, when you get enrolled into Original Medicare, guys, you are going to still have to pay. There is a certain percentage that you yourself are responsible for. So for those that were working or are still working or just going into the Medicare field, it still is the 80-20 rule. Okay, so what does that mean? That means Medicare is responsible for 80% and you are responsible for the other 20. Okay, now, you may have heard of something called a Medicare Advantage plan or a Medicare Supplement plan. Now, those plans are helped to bridge the gap, okay? And what do I mean by bridge the gap? I mean they are set in place to lower that 20% that you are responsible for, okay? So, you want to be in retirement. You don't want to be responsible for 20%. You want to be responsible for 8%, 5%, God willing, 0%, okay? So you are going to need to bridge that gap with either a Medicare Advantage plan or a Medicare Supplement plan, okay? Now, there are going to be differences and which one is going to be the right plan for you. You want to make sure that you're picking the plan that is best for you, not the plan that your neighbor told you to pick or a loved one or a friend, okay? Everyone's needs are different. So we need to make sure that we are making sure that we pick the best plan for us in a nutshell, guys. So the difference between Medicare Advantage and the difference between a supplement is going to be this. A Medicare Advantage plan is going to be a $0 premium. You're going to pay nothing for it, okay? Now, the difference with another attribute of the Medicare Advantage plan is that you'll get a primary care physician and you'll also get a referral specialist, okay? Now, you will have to go to that primary care physician and that referral specialist that is in your network. Those doctors must be within your network. Now, you do have copays with a Medicare Advantage plan, and your drug plan is all built in, okay? Now, with the Medicare Supplement plan, that ranges from about $150 to $200 a month, okay? That's not gonna be a $0 monthly premium. Now, after you pay $150 to $200 a month for your supplement, you're gonna also have to outsource your drug plan. It is not built in like it is with the Medicare Advantage, okay? So those are going to be the difference of each plan. Now, if you want to know which plan is right for you, there's a couple of questions that you can ask yourself or ask later on, whether you travel or not. If you're someone that travels a lot or in retirement, or when you get into retirement, you plan to travel, well, then you want a Medicare supplement plan because you don't want to have to go to a doctor that's in your network, because what if you're on vacation and you get sick and need to go to the doctor? That's definitely not going to be in your network, and it's going to put you in a lot of debt to go to that hospital, okay? So we want to make sure that we're picking the right plans. Now, as we move along, we want to talk about our long-term care, guys. Now, they say that 70% of all seniors will need long-term care at some point in time in their life, okay? If you live to be 85, 86, 87, 88, 89, you will need some type of assistance, okay? So we want to make sure that we have that insurance in place, okay? Going to a living facility can cost you $50,000, $60,000, $70,000 a year to go into one of those facilities. And that's just to go into a basic facility, guys. Now, if you ask yourself, based upon your own assets, how long would you be able to stay in one of those facilities? Okay. For myself, not long, right? So we want to make sure that we're not setting ourselves up properly for retirement and allowing long-term care to be the one thing that cripples us in retirement, okay? So I do want to share a note with you guys that maybe some of you guys didn't know. We all have long-term care. We all do. And it is Medicaid, which no one should be thrilled about, okay? Because that means you're involved with Medicaid spend down. So all of your assets are gone, down to $2,000. The equity in your home, they're gonna take everything from you, right? Before they step in and are willing to assist you, right? Before you think about the government, they're not going to step in and help you until you're already depleted, right? They're not going to leave you with a lot of money and then step in and give you money. So we want to make sure that we have the adequate long-term care coverage in place. Now, if you want to know how Medicaid became long-term care for everyone, it came from the Florida Partnership Program. Now, the Florida Partnership Program, as everyone knows, when people retire, everyone likes to move to the state of Florida, right? Everyone wants to move to the state of Florida. There's no state tax, right? There's warm weather. Well, there were so many retirees moving to the state of Florida at one point in time that didn't have adequate long-term care coverage that they almost bankrupt the state of Florida, okay? That is when the Florida Partnership Program was adopted. And then they adopted it across the other 49 states, right? Because no one wanted to follow suit in what had just transpired with the state of Florida. And that is where you see Medicaid, okay? If you think about it, think about some of your parents. A lot of your parents didn't have long-term care coverage. You or your siblings or their siblings helped take care of them, or your aunt or your uncle. You know someone in that particular situation, right? So we want to make sure that we get adequate long-term care coverage. Now, I don't know if you all have life insurance or not, but I do want to touch on this. If you haven't had someone review your policy, understand that long-term care coverage comes in your life insurance policies these days, guys. So if you're not checking on your policies, you're not having your policies reviewed, or you don't have life insurance at all, I suggest that you do that as quick as possible. You want to make sure that you are well-rounded. Do not set yourself up financially to have a great retirement and allow this one little crack in your foundation to cripple you. Okay? Now, as we move along and we get into our retirement here, right? We start talking about the road to retirement. Let's start looking at some statistics for African Americans, right? They did a poll in 2021 based upon other ethnicities versus Caucasian households. And Caucasian households in 2021 had 9.2 times the amount of money as African American households. Why is that? Look at the Hispanics. Even the Hispanics had us beat. Right? So definitely want to make a change in understanding, get the education to make sure that we can make those changes. So if we look at this screen here, this is about our money. What do we have here? CDs, stocks, bonds, mutual funds, 401ks, IRAs, 403bs, 457s, checking and savings. What do all these things have in common? Some would say investment accounts. Some would say retirement accounts. Some would say interest. Some would say just money. I would say taxes. These are the accounts that they told you to get in order to retire, but these are also the highest tax retirement accounts you can get, right? So is that by design or is that a coincidence? I happen to think it's by design, right? So let's really dive into a lot of these different topics and really take a look at them a little more in depth. From our checking and savings standpoint, right? If I go into a bank today and I deposit $10,000 and you yourself go into the bank tomorrow, right? And you apply for a loan, what happened? They gave me nothing for putting my money, right, in that financial institution, that $10,000. And then you applied for a loan the very next day and they loaned you my money. And because it's a cash loan, what happened? They hit you at 21, 22%, 23%, right? Interest, right? Now, does anyone see that as fair? I put my money into an account, right? They didn't give me anything for putting my money in that financial institution. My neighbor goes in there the very next day, applies for a loan. They give them my $10,000 and give them the highest interest rate they possibly could, right? Then we go into that same bank and we apply for a loan for a house, right? And we apply for that house and it's a $300,000 house and we put $65,000 down and we end up with a 4.5% interest rate. Now that's going to give us roughly a $1,500 a month mortgage, right? Now, if I said 4.5% interest rate and my mortgage is $1,500, then why did 1,063 of my first payment go towards interest? Doesn't sound like 4.5% interest, does it? If 1,063 of my $1,500 payment is going towards interest on my first payment, right? So we understand that the banks, it's never what they say. We understand that as over 30 years, we're going to pay double for that home. That home is going to end up being a $600,000 home. And we're not even talking about the renovation nor the taxes that we put into it. But that home isn't going to double in value in 30 years, right? Zillow is going to say $550,000 and now it's paid off and you're in retirement, right? But when you look at the ticket price plus the interest, you're at $600,000, right? So you're still $50,000 upside down in your investment, right? But you think because it's paid off, you own it, it's yours. Don't pay the taxes and see if you own it, right? You still don't own it. Uncle Sam will forever own it, the bank or Uncle Sam, right? You'll forever pay. So that's another investment where there's a myth, right? Then we go to that same bank and we go to invest in that bank, right? We want to do IRAs, we want to do other investments, stocks, bonds within that bank, not understanding that the only way that that bank could actually be open is because they're putting us in debt, right? Bank can't stay open without giving loans, which is debt. So why would we go to a place where the only way that they can stay open is by putting us in debt to get rich? Debt and rich don't go together. There's only one type of good debt. But 9 times out of 10, debt and rich don't go together. Okay? So we can understand that there's flaws. Now let's look at the CD. Look at our CD. Now, before COVID, CDs were given less return than an actual bank account, which we already established gives you nothing, right? So CDs were obsolete at one time. Now, after COVID, you see these credit unions coming out with 6 months and 12 months for maybe, 5-6% interest rate, right? But inflation's at what? 9.5, 10%. So that's not even effective, right? Because it's not even performing to keep you above inflation. So we can't talk about the CDs at all because they're not even effective. Now, what about our stocks, bonds, and mutual funds that we see here, right? Stocks, bonds, mutual funds. Let's really look at the system when it comes to those things, right? I ask all of you on the call right now, are you more impressed with what you net or are you more impressed with what you gross? I'm more impressed with what I net, right? What's on paper means nothing to me. I care everything about what's tangible, what I can touch, right? So stocks, bonds, mutual funds. Let's really look at it in an economy like what we have going on for the last 2 years and have what we have going on moving forward. We have a downward economy, right? For a lot of folks, right? As far as they're losing. So in the market, whether it's your 401k, your IRA, your stocks, any of those things, you're losing. You're seeing a fluctuation. So you have the market taking your money. Then you have your advisor taking your money. Then you need to take your money. Then Uncle Sam's going to come take your money after you take your money because you got to pay taxes. That's 4 hands. The market, the advisor, you, Uncle Sam. How much money do you really have, right? So when you really think about it, you have 50% tangible of what you actually see on paper. And that's systematic because we all know that the government needs to reset. Look, we get 5 good years, we get a few shaky years, and then we get 2, 3 bad years, just straight bad, right? Then we need to reset, and then it turns around, and then we get 5 good years again. We've all seen the cycle, right? So we know we have to deal with the fluctuations, right? So we understand that with 4 hands in a pot, we really do not touch what we actually gross, right? And then from there, after the 4 hands go in the pot, and then you want to pass it down to your loved ones after you're no longer here, who's coming to get some of that before your loved ones? Uncle Sam. So you already only going to walk away with 50% of what you actually even made in this world. And then you want to leave that to your loved ones, and then Uncle Sam's going to come get 30 to 36% of that before it goes to your loved ones. So for us African Americans, what are we really leaving our kids? What legacy are we really leaving behind when we actually really break down the system? Now, from a 401k standpoint, let's talk about the 401k. Average American works 30 years and we retire, right? Now, if we do what the government told us to do, which was to invest into our 401k so that we can retire, have a great life, right? What happens if you need to tap into that 401k? Kids go to college, kid turns 16, he needs a car. You need to tap into that 401k early. What happens? Penalty, 10%. What happens? Taxes, right? When they're teaching us to make that our biggest savings vehicle, our retirement accounts, right? So let's look at why that's done. Let's look at the IRA. Now, the IRA says that we can put in $6,000 a year. and the IRS gives us a $6,000 tax deductible. You ever ask yourself, why would the government give you a pat on the back for contributing to your own retirement? What's in it for them, right? So let's look at this. So if we just said the average American works 30 years and we go to retire, right? So as we contribute $6,000 a year, $6,000 a year, and we continue to grow, right? The government continues to give us that $6,000 tax deductible, because what do they want to happen? They want your accounts to grow. They want it to build over 30 years, right? Would you rather have someone's seed, or would you rather have someone's harvest? Right? Would you rather have someone's seed, or would you rather have someone's harvest? Right? So they allow it to grow for 30 years and then you go to retire. Well, can you live on $6,000 a year? You cannot, right? You need $40,000, $50,000, $60,000 a year. And when you pull that $40,000, $50,000, $60,000 a year, you're going to get taxed, right? So essentially, you're going to pay more in taxes in your first 3 to 5 years of retirement than you ever received in deductibles in 30, right? By design. And you're at your weakest point. Your kids are grown. You don't have any write-offs really, like you did when you were working. But what do you have? You have 30 years worth of savings, don't you? Right? So we start to understand the agenda of the banks and the governments. Now, what else do these accounts have in common? They're also attachable assets, right? What is an attachable asset? An attachable asset means that this can be stripped away from you. When we look at what you're worth, your net worth, when we look at your assets, when we look at what you have, this is what we're looking at. These are all the things that can be stripped away from you, from lawsuits, alimony, child support, right? Probate, right? These are all the things that can be taken from you, from a car accident, right? Accidents, right? So we want to make sure that we can protect ourselves. So the one thing we want to ask ourselves in this moment is, why would they teach us growing up to put all of our money in places where it's unprotected and highly taxed? So if they taught us about attachable assets, there has to be an opposite. And there is. Opposites are non-attachable assets, right? Now, what are non-attachable assets? Life insurance. What's another non-attachable asset? Annuity, right? Now, when it comes to the life insurance and annuities being non-attached assets, I'm sure everyone has heard of O.J. Simpson, and I'm sure everyone remembers the Enron story. Now, O.J. Simpson, as far as the civil suit is concerned, he was ordered to pay millions to the Goldman family. But how much has he paid? Zero. Why? Legally, too. Why? Because all of his money is in an annuity. No matter what a judge says, no matter what they rule, legally, he will never pay them a dime, and there's nothing that anyone will ever be able to do about it. Now, when it comes to the Enron story, let's take a look at that. He stole billions from those families, right? He stole billions from a family and put it into a life insurance policy for his wife. Now, not any type of life insurance where they're pulling and living off of it tax-free. Imagine living off $1 billion tax-free. That's growing at 8 to 10%, right? So there are policies like that. Life insurance is not just for burial. But let's take a look at that. So he's in jail. The billions of dollars is in the life insurance policy. They've been ordered to pay those families back, but they never did and never will. Why? Because it's in a non-attachable asset, guys. You cannot take a non-attachable asset from someone. You are fully protected from that aspect. Now, at this point, let's take a look at what the tax code says. Tax code 7702 says that it's illegal to tax death benefit money. So let's start to look at that again. Tax code 7702 says it's illegal to tax death benefit money. Now, if these insurance companies have financial products, then surely we can get our hands on these type of funds to be able to pass down to our children, so that Uncle Sam can't tax our income, right? We start to get our money back. We start to take some of those hands out of the pot. Now, how do we do that? Let's look at a different example. Let's look at the red chart, the red line as well as the green line. We're going to look at both of them at the same time. Now, Ms. Johnson in 1998, she retired with $100,000. Now, in the year 2000, we had Y2K. And then 2001, we had 9/11. Now, by the year 2000, Ms. Johnson had got her money, if you're looking at the red line, she got her money up to $151,000. Now, when Y2K came and 9/11 came, it tanked her money, right? All the way into 2003, down to $90,000. But in the annuity, look what the annuity did. Look at that green line. That red line sunk down to the bottom. What is that green line doing? That green line is staying in the middle, median. It's not making money, but it's not losing money either, right? Now, how long did it take Ms. Johnson to recover? If you're looking at the red line, how long did it take her to recover to get her $151,000 back? She lost it in 4 years, but it took 6 years to get it back, right? So in 2002, it took 6 years. So now we're in 2008. What happened in 2008? The market crashed. We had a recession, guys, right? How many of your advisors, how many of your money market guys called you and told you we're heading into a recession to pull your money so you don't lose anything? I know people right now who still haven't recovered from 2008. Okay, so as we see in 2008, we had a recession. The market crashed again. Let's look at that green line. Green line's not losing anything, right? We're capturing everything, right? And we're keeping our money in our pocket because we don't have fees, all right? So if we look at 2008, it's exactly what I said. Ms. Johnson, she has her money in the market. So now the market's taking her money. Her advisor's taking her money too, because he's still going to get paid whether you make money or whether you don't, right? Now she needs to live off this money as well. So she's going to pull some money too. And then here comes Uncle Sam right after she pulls it, right? So we can understand that the annuity is way, way, way more effective as far as growth, along with less stress, right? Let's continue to look. Let's look at why people invest in the market. They say, well, we can get better returns. Well, let's actually look at how the advisor gets paid in the market. Because AARP says 8 out of 10 seniors don't know what they're paying in fees. Okay, so if we look at Joe retired at 65, and he let his advisor manage $200,000. Now the account grows at 5% on average. So from 65 to 90, the account grew from 200,000 to 413,000. That's great. Well, not really in the market for 5%, but great. It went up, not down. Let's look at, since the account grew, so did Joe's advisory fees, right? So from 65 to 70, the advisor took 11,000 from Joe. From 65 to 75, the advisor had taken 25,000 from Joe. From 65 to 80, he had taken 41,000 from Joe. From 65 to 85, he had taken 62,000 from Joe. Now from 65 to 90, he had taken a total of $86,000 from Joe. Wow. $86,000 gone from Joe from 65 to 90. Now, Joe didn't just lose $86,000, and we're going to talk about that in just a moment. Now, if Joe grew his money from 200 to 413, right? And then he gave up 86,000, he's left with what you see in green, 326,000. Now, if your advisor is supposed to get 1% and your account is 14,000, and you have to give up 86,000 to your advisor, that is well over 1%. It's almost like that 4.5% interest rate on that home that we talked about earlier, right? So as we continue to look, because this is exactly how it works, as we continue to look, Joe just didn't lose $86,000. We are conditioned to look at the money that we put out or we lose, and that's it. right? If I'm an investor and I lose $20 out of my pocket, I didn't just lose the $20. I lost what I could have made investing that $20 because I'm an investor, because money makes money. So I lost out on the $20 that fell out of my pocket, and I also lost out on what the $20 could have made me. So we did say that the account was growing at 5%, right? So let's take a look at what that 86,000 could have made Joe at 5% had that advisor not taken it from him in fees. Looks like Joe would have made an extra 63 grand, right? Had he been able to keep the 86,000. So total 86,000 plus what he could have made, which would have been an extra 63,000 had that 86,000 stayed in his account. He really totally lost 150,000. Okay? That's one thing I want to teach you guys. The wealthy look at opportunity cost. I'm going to say that again. Wealthy people look at the opportunity cost. That's why they're so frugal with their money. They know that money is supposed to make money. Okay? So just dishing out money, they're losing not only the money that they're giving out, they're losing opportunities too. Now, let's go back and look. Remember I said you walk away with less than 50% of your money? Let's give it a breakdown. We grew our money to 413,000. We gave up 86,000 to the advisor. That's 21% of your money. Okay, I'll say that again. You grew it to 413,000. You gave up 86,000 to your advisor. That's 21% of your money. You're left with 79%. Okay, now you go to use that 79%. Who's coming to look for you? Uncle Sam. And what tax bracket are you in? So again, you're either walking away with 50% or less of your money at the end of the day, once we actually break down the system, right? So let's continue to look, guys. Let's look at the annuity side of things, because we already know that tax code 7702 says that it's illegal to tax death benefit money, right? Let's start looking at how we bridge that gap and how we get the hands out of the pot. With the fixed indexed annuity, there's no fees. Okay, so we remember, guys, there was 4 hands in the pots at one time, wasn't it? So let's start going over taking the hands out of the pot. Okay, so when we go into an annuity, there's no fees, so we're gonna get the advisor's hands out of the pot. That's 1. Now we down to left to just 3 hands in the pot. With an annuity, we already looked at the green line and understood that we can't lose money. So the market can't take our money. That's another hand out of the pot. Okay? Now, once we go into this annuity, it is a tax-deferred vehicle. So for all you people that are playing stocks and bonds and mutual funds, that's going to lower your tax liability, guys. That's another hand out of the pot. So now we got 3 hands out of the pot. The only hand that's left in the pot at this point is you, which is how it should be. Now, if you got 3 hands out of the pot and that money is allowed to go back to your principal for better growth, what type of retirement do you have in an account where the taxes are reduced? And when you pass away, tax code 7702 says you can't tax death benefit money. So whoever your beneficiary is gets all of your assets 100% outright, and Uncle Sam can't get $1 of it, right? So let's really break down this annuity. This one particular company, if you guys look, age 65, premium, she's rolling $500,000, right? $500,000, right? If you guys can see. Now, at 65, now they're going to get a 10% day 1 bonus. Okay, you're going to get a 10% day 1 bonus, which is automatically going to put their account value at $550,000. Okay, now if you see that, let's look at the first 2 years within the vehicle. Okay, now if we're looking at the first 2 years, by age 67, she's looking at $799,000. Okay. Now, if I like to look at the 5-year marker and I like to look at the 10-year marker, most people have 5-year goals, they have 10-year goals. So if we look at age 70, we're looking at over $1 million. So we started at 65 with 500,000. We were given a 10% day one bonus, which put us at 550,000, right? Now, in 5 years, we were able to double our money to get us over $1 million. Now let's look at that 10-year marker. If we look at that 10-year marker, age 75, we have $1.8 million from this growth. And a 100% safe vehicle where we know we can't lose. Now, they say the life expectancy of a female is 87 years old, they say. That's what Google says. The statistics show. So if we look at age 87, which is all the way at the bottom of the screen, $8.9 million. And you get to live off of this money. This annuity gives you a lifetime income, which gives you security in retirement, which assures that you do not have to go back out into working world. So that's another thing that this is going to provide for you, right? Now, again, when we talk about bridging the gap as far as legacy, if you were to pass away, God forbid, let's say at 87, and you had that $8.9 million in your annuity, right? The $8.9 million, that is a death benefit. So your beneficiary is going to receive that 100% tax free. Uncle Sam gets nothing. Had it been in the 401k, IRA, CD, attachable assets, 33 to 36%. And at $8.9 million, you're in a way different tax bracket. So over 50% of that's gone. That's for sure. Right? You grow your stocks, bond, mutual funds to $8.9 million. And I promise you 50% or more is gone for sure. Okay. So we want to put that money back into our pockets. Now, just to break down, on the left side is what you get with the market. On the right side is what you get with the annuity pension plan. So on the left, the asset accumulators, you get market loss, no guarantees, front and back end fees with your advisor, right? We've talked about extra taxes, no lifetime income, and you don't get that long-term care or those living benefits like we talked about in the beginning. And you're subject to probate court because there's no beneficiary. But if we look at the annuity side, there's no market loss, low to no fees. Now, RMDs have changed to age 73. If you don't know what RMDs are, that's required minimum distribution. At age 73, the IRS says they're going to make you pull from your retirement vehicle so that they can tax you and get their portion. Remember, they want the harvest and not the seed. So at 73, whether you need the money or not, you are forced to pull from that account and so that they can get their tax dollars. That's why they gave you that pat on the back for 30 years so that you can contribute to your retirement vehicles. Now, you will avoid probate for those that have been remarried, so because you have designated beneficiaries. Again, the annuity provides lifetime income. No matter if you're 60 years old and you retire and roll your money into an annuity, you can live to be 200 years old. And guess what? That annuity is going to pay you until you're 200 years old. Okay? Just like a Social Security check. It provides security with no risk. Now, you will get long-term care coverage built into these annuities. The living benefits are built into it, as well as the payouts and the death benefits can be a benefit, or a portion can go towards mortgage protection, making sure that the house is paid off when you're no longer here, with just the money that you're saving from Uncle Sam not getting a piece, right? So, again, guys, I do thank you for attending this webinar. I am going to open it up for Q&A as far as being able to ask any questions that you may have. I'm going to give roughly, the next 15 minutes until 5 o'clock to kind of ask me some questions if you do have any.
Okay, I'm sorry.
There are
very good. A lot of good information, Ken. I think you're all okay. Let me. So So we have some questions in the chats. And Michelle and Kilthea, do you guys, can you see the questions?
I know there was
Kennard?
one that caught my attention. It was one lady said that one person said that she was getting fees on her annuity. And I'm just thinking maybe there's
She has a variable.
Okay. Okay.
She has a variable annuity. That's why she's receiving fees. You need to get out of that. There's no reason for you to be in that because it's just like being in the market. If you're going to have fees with an advisor and fluctuation in the market, because if you're having fees, then you're also having loss as well. So there's no really real reason to be in that because with a variable annuity, you're getting minimum risk. I'm sorry, you're getting minimum gains while also being able to still lose. That's not beneficial to you.
Ken, can you move your camera down a little bit? I'm missing the top of your head.
Oh,
Kennard, can you hear me?
hard.
I need to go up just a little bit.
Bring it up so I can, so I can see your head.
So, go ahead. Yeah.
That's
All
good.
right.
There you go.
So can
Go ahead. If you have a question, raise your hand and we'll get your question on. I'm gonna scan the chats.
I just wanted to go back to the variable. You said she had a variable. What is the other type of account called?
Fixed index.
Thanks.
Okay. Do you see there were other questions in the chats? I'm trying to do two things at once. Do you see them?
Yeah, I
Michelle,
wanted to give a testimonial that,
There's,
if I may. I had gone to a seminar like this, I don't know, when I left Duke and heard this, similar information, and I decided to move my 401k over to fixed income annuity. And it was interesting because when the market dropped, I had a friend who worked for Merrill Lynch and her sons also work for these big financial companies. She told me, oh, we took such a hit. Michelle, did you take, how big was your hit? And I said, I didn't get a hit. And she said, yes, you did. Everybody got a hit. I said, no, I didn't get a hit. And she was invested that I lost money in the stock market because it dropped and everybody did. And then next time I talked, she goes, oh, you had a fixed income annuity. I said, yes, I did. So that's just my testimony for the reason to move my money out of the 401k and put it into, as Mr. Kennard said, into a fixed income annuity.
So Kennard, when we say fixed annuities, what's an example of a fixed annuity? Or is that a logical question?
No.
I
An
don't know.
example, well, look at it like, okay, I could somewhat give you an example. A retirement pension would be a form, but there's other attributes that go along to it. So,
may I ask a question?
so imagine
Go ahead.
someone asking a question.
Yeah, so I thought, to me, a fixed income means like there's a set rate, like 8%, and you're guaranteed at 8%. No, whereas a variable, it can go up and down.
Fixed indexed annuity. Indexed.
All right, it's like a mutual fund.
Index.
Right, so it's an
Correct.
average of all
Index.
the major, like the Standard & Poor's and things like that.
I'm sorry, repeat that question. I couldn't hear you.
So when you say the index, that means it takes an average of like the Standard & Poor's and those other major stock markets, and you get your interest based on that?
You get your interest based upon how I allocate it for you. I used to be a financial advisor. So
Okay.
me now stepping into the insurance world, to be able to allocate annuities is almost like having a college guy that's doing math, and then you put them back in middle school and have them doing math. It's like 1, 2, 3. So that's where you see the extensive growth. That chart that I just showed you guys was my allocation. So that's why you see such great growth in something that has no risk involved. It has nothing to do with the actual product itself. It's the allocation of the actual agent. So
Right.
the difference between having me and having someone else, the average insurance agent just comes into the insurance world to sell insurance policies. They find out about the financial side and they end up learning it. I came from a financial background with putting people's money in stocks and bonds and then moved to the insurance world. So these products are like ABCs and 1, 2, 3s to me. I can maximize them with my eyes closed. So again, that is why you're seeing a difference in great growth with something that's protected, because you don't really see that type of growth with something that has no risk. Something that has no risk is going to give you minimum gains
Right.
because it has no risk.
So are these funds
There's a question-
insured?
Go ahead.
There's a question in the chat. What expenses are associated with setting up an annuity? And I'd like to piggyback another question on that. If there is no fee, how do you get paid? So the
Commission
first
through
one
the
was
insurance
what,
company.
the first one was what expenses are associated with setting up an annuity?
Depends on the product. Depends on the product and the company that you so choose to go with. I'm a broker, so I represent them all. There's one company I'd put you with that does have certain things associated with it, and there's companies that don't. There's going to be Ms. Brown and Ms. Johnson are going to want two different things, and I have to be able to meet both of their needs, right? So to really answer that question, it's just based upon your needs and the product. If your needs put you in a product that has nothing associated to it, then that's where you'll be. If your needs is somewhere where it does, then that's where we put you. To answer your second question, if we remember the annuity bonus that you got, which was that 10%, it doesn't come from any of you all's money. I'm paid a one-time commission through the insurance company for placing you with that particular insurance company, because I'm a broker and I don't have to put you with that particular company. So as a thank you, they're paying me a commission one time. I would never stand in front of a crowd and tell people to take hands out of the pot and get, advisory, fees and things out of your retirement and then charge you all a fee. So
there's a question here. It says, can you change a variable annuity into a fixed annuity?
yes, it's called a
Okay.
rollover, just like you would do a 401k or an IRA or anything of that nature.
How do you move into a fixed index annuity? Can't imagine that it can be done for free.
Yeah, I've been doing it for 10 years for free. So if it's not, I've been hurting myself. No, you're able to do it's a very simple process that you're able to set up with me. My Calendly link was linked to it. I'll be able to discuss those things in a one-on-one basis. So there's certain things I'm allowed to talk about in a group setting, and there's certain things that I'm not. So
I've added his link several times in the chat for those who are on the call. And it's in the email also that you received.
And
It is a
Ms.
free
Cherokee-
consultation. I do not charge.
Yeah, Ms. Cherokee Thomas has had her
So let me
hand.
disclaim that I don't want people not wanting to click on the link because they feel that I charge. I don't charge for consultations. I don't charge to give you guys free knowledge and information. There are certain things that I cannot talk about in group settings legally by law because these are state regulated programs, but I can talk about one-on-one. So there's a lot that I didn't talk about in this presentation that I want to be able to fill you guys in on how to lower tax liabilities and things of that nature. So definitely click that Calendly. Also, if you do, you might want to do it very promptly. Tuesday, I will be traveling to Baltimore for 3 days where I will be presenting 3 nights in a row. And that's where Michelle met me. She met me in Durham because I was presenting in Durham. That is how we met, and that's why I'm here. I'll be in Baltimore this upcoming week. And I promise you, once we get till about Wednesday this week, Michelle can tell you, it's going to get very difficult to contact me. Okay, because I am very, very busy from sun up to sundown. So please, if you have any questions, if you do want to talk to me about anything on a one-on-one basis, I will be able to answer your questions and give knowledge based upon your personal circumstances, guys.
We have a hand. Ms. Thomas, go ahead with your question.
Hi, good afternoon. Um, my question was, you said something about annuities cannot be taxed. Did you mean federal tax? Or I inherited a annuity, so inheritance, I'm being taxed through the state by inheritance tax. Is that something different?
Yeah, you were the beneficiary of that? Yeah, you shouldn't have been paying taxes. Click that link.
Okay,
Yeah, you shouldn't have been paying taxes.
but it's an inheritance tax, not federal tax, because I had it rolled over into our IRA, inherited IRA. So it's
And
not getting
how did
taxed
you had it
federally.
rolled or did you
I
cash
have it rolled over. I didn't cash it out anything. I had it rolled over into
had it
an
paid out to
inherited
the
IRA.
institution on your behalf, right?
Mm-hmm.
And
It's
you paid it,
not
you paid
federal tax, but it's inheritance tax
okay, yes,
to the state.
inheritance. No state federal.
Right.
Is that what I'm hearing from you? It's
Okay.
hard to hear
Just
you.
want to make sure. Yes.
Did she say yes?
Yeah, inheritance tax. No.
Okay. I'm sorry, my guy that's working this can hear you. It's a little hard to hear you.
Yes.
Yes,
It's
he does.
inheritance tax.
Okay, yes, no state, no federal, right? Thumbs up?
Miss Thomas, no state, no federal?
No state, no federal.
Okay,
No state, no federal. Just
Okay.
inheritance.
okay.
All right, hit that link, Miss Thomas, and talk with him privately on that. Let me see. My Advantage plan claims to have coverage nationally. Is that not so? As opposed to the supplement we're talking.
Depends on if she has an HMO or if she's gonna have a PPO. Depends. Depends on what she's got.
Okay, I'm not sure whose question that was. I hope you are still here to get the answer.
I think it was
Let's see.
Vanessa, and I think she's gone.
Is she still here? Okay.
I don't think so. But if you
Let's,
can answer, I'll pass it on.
okay.
You have a
There was
question.
one question in the chat, if you would, Mr. Dixon. It was deferring taxes, not eliminating them, right? I don't remember which topic you were on at that point, but I guess the question
The
is,
type of account versus what happens at the end. So the type of account is a tax deferred vehicle. That's the type of account. Now, when we talk about as far as death benefit, you don't pay taxes at all. Now, tax deferred is going to be representing the person while living and using those funds. Death benefit is once the person has passed away and is going to a beneficiary. So a tax deferred account is the type of an account that the annuity is. The tax code 7702 is which allows you to pass it down to your beneficiary 100% tax free because it's considered death benefit money.
Can you talk a little bit more about life insurance? Because are we talking whole life, term life? What are we talking? In terms, particularly in terms of you said you can use your life insurance to protect you for long-term care. Is that would be a whole life policy?
Those are going to be whole life policies. That is correct.
Okay. Here's a question. Are Roth RIAs good to have when it comes to being taxed upon withdrawals? This person has traditional and Roth.
No, a Roth is going to be great, but it just as far as taxes is concerned. But should you have a Roth, depends on what age you are.
Okay.
Should you even have that? So a Roth is going to be great for tax as far as you're pulling the money because it's after tax. It's after tax, but after a certain age, a certain person shouldn't have a Roth at all.
Why?
Because you're dealing with the fluctuation of the market. Yeah, there's no tax, but the market is still taking your money. And
Okay.
if you also have a Roth, the advisor is still taking your money. This is everything we just talked about. And then if you hit me or T-bone me in a car accident, I'm going to take your money.
Okay.
Okay. So
Thanks.
here's a question from a younger person. I am a single 37-year-old with no children. I have $120,000 in student loan debts. for someone like myself who is literally starting from scratch with no investments, assets, retirement, or saving, where should I be?
You need an index universal life policy.
Did you hear that, Miss, the person who asked that question, an index?
So life insurance is used to dodge taxes and to begin.
I didn't hear the answer. I'm the one who posed the question. Can you repeat the answer?
You want an IUL, which stands for an index universal life policy. That is what you want for yourself. Life insurance is used to dodge taxes and to get out of debt. That is what you want.
Somebody said, where is he located? He's in North Carolina, but he works in several states. Oh, he's not in North Carolina.
No.
Oh, he's in
Richmond,
Virginia. I'm
Virginia.
sorry. He's in Virginia. How could I forget? But he works in several states, so it's okay. If you want to reach out to him, he can still work with you.
And Ken, could you share how your Calendly thing works again?
Yes, if you click my Calendly link, it will allow you to automatically, once you book an appointment to talk with me, it's going to automatically show up on my calendar, and it automatically creates the Zoom link for me so that we can actually be face-to-face via Zoom. You can talk to me about everything that you have going on, and I am going to be able to guide you guys in the right direction, and then also be able to provide a lot more information on a one-on-one basis than I can in a group setting.
Great.
And there is no charge, guys.
You have time for
Well, one last question, because I know you got to go. It says, would the annuity be tax-free if a family trust is my beneficiary?
Yes, but what type of trust do you don't want a revocable trust?
Imani, did you want to ask that question? Imani? Did you want to get clarity? You can ask the question yourself. Imani, are you still here?
Can't hear you.
I don't see her.
Hi, I'm sorry. What it is that right now I inherited actually an annuity from my mother. Small, but it's been very useful lately because I'll be 78 shortly. Okay, so this income has been helpful to me, but my question is, well, twofold. Right now I have my annuity, my family trust as the beneficiary. When I pass away and then they inherit, that trust inherits that amount of money, whatever's left in that annuity, or any new one that I might set up, would the trust also be tax-free? Or would the trust get taxed?
No, it won't be taxed.
But you said it has to be an irrevocable?
Yes, you don't have a revocable, do you? Because that's not fully protected.
Yeah, I have a revocable.
Okay, you want an irrevocable. Do you understand the difference between?
Yeah.
Okay.
I'll have to change that.
Because so you understanding with the revocable, you're still not protected. Do you understand how you're not protected?
Tell us all for somebody else who might want to know.
So, because it's revocable. So you can have all of your assets in, let's say you got $1 million in a trust, you T-bone me, we go to court, I get ordered, the judge says you owe me $1 million, but your assets is in a revocable trust. The judge is just going to revoke it. It's mine now.
Someone irrevocable.
Yeah.
Okay. Yeah. Thank you very much.
No problem. Please click the link. We can talk a lot more.
Okay. Thank you.
Yeah, somebody, I think you provoked a question here. They wanted to know, how do you get out of debt with universal life insurance? Can you borrow from that? And what do you think about real estate and building wealth?
That's really the way that you're gonna use it. An IUL should give you just a basic concept of it. Someone asked earlier in the questions about a Roth. Look at an IUL, just like a life insurance policy with a Roth built into it. So it was designed by the wealthy, right? So when we talk about real estate, I'll answer both of those questions in one. Let me give you an example of one of my clients. Let me give you an example. Mr. Johnson's he's 3 years away from retirement, didn't really save well. So he got an IUL. He started putting $1,000 a month into this IUL. Well, this IUL is growing at 8 or 9%. Okay. So that's a life insurance that has basically a Roth attached to it. So it's indexed. So it's growing. Okay. Now we use the rules of the wealthy once it actually grows. Okay. Now, if we have $1,000 a month going into an account that's growing at 8, 9%, why would we ever stop that from growing? We wouldn't, right? So 3 years goes by and we say to the insurance company, hey, let me leverage. I got 40,000 in there. Let me leverage my $40,000, loan it to me. And the insurance company is going to say, yeah, because you got 40,000 now sitting there and growing percent. Now, what can't you do to loan money? You can't tax it. So now this money that I'm getting is tax-free. And essentially, I just borrowed it from myself. Now, this client that I'm talking about, he then buys a duplex for $40,000. He rents each side out for $1,500 a piece. Okay, so that's $3,000 a month in income that he's getting back from the duplex, right? Plus the $1,000 that he's paying a month to the IUL. So now he's got $4,000 a month going back to an IUL that's growing at 8, 9% that he borrowed from himself, and he owns a duplex outright. Right? Because we're leveraging our money and we're taking a loan. We're never going to stop our money from growing. We leverage it. Once we leverage it, we get the loan. Loan you cannot tax. Right? So now this is non-taxable income. In reality, all I did was borrow it from myself.
That's pretty cool.
Right? And so we use this, that's just the concept, but we use this same technique to snowball your debt. Okay? So let me ask you this. Let me give you an example. Ms. Johnson has a credit card that's growing, that she has a credit card and she has, let's say, a furniture note. Now the credit card interest is growing at 22% and she owes $10,000. Let's just keep it there. Doesn't it make sense to tap into your IUL and borrow it from yourself? And let's say the insurance company says, okay, well, your money's growing at 8%. I'll give it to you, but I'm going to loan you this money at 9%. Okay, stay with me. Stay with me. Your money's growing at 8%. I'm going to loan it to you at 9%. You just got a cash loan from yourself for essentially less than, well, 1%, right? Where can you go get a cash loan for 1%? Nowhere, right? Your credit didn't get dinged at all, did it? Now you use that money and you just paid off a credit card that was coming in at 22%. Which one was smarter, right? We just took a loan against ourselves at 1% to pay off debt that was coming in at 22%. Now we have freed up the money that we were paying towards that credit card bill, right? Right? Because if we had the credit card debt, we was paying a bill towards it. But now if the credit card is now paid off, now we just freed up some extra money, didn't we? Now that we're not paying a credit card bill. Now we take that extra money and we send it to this IUL and we allow it to grow interest so we can find something else that we want to get. And then we're going to loan it, borrow it from ourselves, tax-free. So this is how we snowball debt. So now we look at the next list. We just knocked out the credit card that was growing at 22% interest. What is the next debt on our list that has the next highest interest rate? And we're going to clear that out. And we just snowball our debt and get out of debt. But I can talk more about that with you on a one-on-one as well.
Okay, and on that note, someone asked the questions, what should they do in preparation for a one-on-one with you? What should they bring to the table, to the conversation?
If you'd like me to, if you want to get the best bang for your buck, because I'm not charging you anything, have everything that we talked about. If you have a life insurance policy, have your life insurance policy with you so that we can go over reviews and make sure you got the best. If you want to talk about annuities and investments, please, if you don't have your statement, at least know, and this may sound strange, but I do this every day. It's for a long time and you wouldn't believe, but please at least know what type of account you have. Okay. You wouldn't imagine the type of people who have 300,000-400,000. And he's like, okay, well, what type of vehicle is it? And they're like, well, I don't even know. That's a good question. So at least if you don't have the statements, which I would like you to have the statements so we can look at exactly what's going on, because I don't want to know just the account that you're in. I want to know, how's it been performing for you? How's it been working for you, right? Before I assess what you should do. I don't want to just say, oh, you have an IRA, this is what you should do. Let's look at the IRA and see how it's been performing for you. So really, to answer that question, just, the statements of what you want to look at, or just so that we can be clear on what we're talking about. That's all.
Makes a lot of sense. You have been just a wealth of information. The feedback in the chats here, which I'm sure your person is going to copy and make sure that you have a lot of good feedback. I think of those of you who want a private meeting, I encourage that you reach out to Mr. Dixon and make that happen. Michelle was extremely impressed with her time with him, and I'm sure that you will be too. So on that note, Mr. Dixon, I know you have something else to do. So I just want to say thank you so much. And if you all will unmute or at least put in the chats your appreciation for his time, I'd appreciate it.
I thank you
Did
all.
you have
I
any,
really appreciate you all.
did you have any closing words, Mr. Dixon?
Two things. They say that by 2053, that African Americans will own less than 3% of America. And so they're talking about me when I'm 65, and they're talking about my kids when they're in their 30s, right? And so I think that's definitely a huge misrepresentation of us and who we are. You guys know better than I do. There's a lot of stolen greatness from us. And I think that we need to remind ourselves of that and create these groups, such as the groups that you all have, and the things that I am doing to remind ourselves of that, and to come back as a whole, to be where we should be, as we all know. And then last but not least, I do just want to leave you guys with the scripture, Hosea 4:6. My people are destroyed for a lack of knowledge. So I hope that you guys enjoyed this Sunday evening webinar. And if you need me, please feel free to reach out. Thank you so much, Michelle, for having me as well.
Thank you.
Thank you. Thank you so
Thank you.
much.
Thank you. Thank you.
Thank you.
Yeah.
Thank
Good
you.
stuff.
Wonderful evening.
Thank
And
you.
I'm looking forward to working with you.
Thank you. Thank you.
Okay, sounds like a plan. Thank you, Mr. Dixon. All right, ladies, let me take us off spotlight. That was a very informative call. I think everybody got something out of it. Why can't I remove? Okay, there you go. Remove the spotlight. Okay, so we're back on gallery. So not that I can answer any of the questions that you might have. So does anybody have anything that they just want to share before we stop recording?
Someone can ask for his contact information if you, oh, can you put that in again? Somebody just came on. Can you put in the contact information again, Helen?
For the appointment, is that what you want,
Yeah.
Ken?
Yeah.
Yeah, I can do that. Yes. And somebody already said that they've already responded and they have an appointment. Go ahead, Miss Roscoe. What's your question, babe?
Thank you. So can everyone hear me? Because it's saying that my internet is low.
I like to.
We can hear you.
Hello?
We hear you.
We can hear you.
babe.
I like to listen.
Can you
Melinda?
hear us?
I like to
We hear you, Melinda. Go ahead.
listen.
I don't know if she can hear us.
She was just speaking.
Yeah.
Yeah, I'm not sure. Does anybody else have something while Melinda's getting situated there? Can somebody drop her a note in the chats, let her know that we can hear, that we can't hear her, I guess. But anyway, this is all good information. I had told him that, the average age, that a lot of people on this call might be interested in Medicare, and he opened right up with that. That's a big deal. It's happening for me in my life right now with one of my family members. So that's important, to know the difference between Medicare, Medicaid, the Advantage, the different parts of Medicare. One of the things that we need to know is I think you have to apply for Medicare at 64 and a half. We should be applying, and at some point, if you haven't applied, there's a penalty. So does anybody know the exact ages for that? So if you're close to that 65 range,
before your 65th birthday, you have to
or
apply.
but don't they give you a small grace period after that, Lola?
Yeah, but let me tell you, don't wait till the last minute. There could be just a little thing wrong. Maybe your name is spelled incorrect. I mean, it was a nightmare for me. It took months. So, oh yeah, because I thought, I was gonna wait just a few days, but until a few days before my 60th birthday. I don't even know the reason. I just wanted to do it as close as possible. Oh my goodness, it was terrible. And what happens is, if you don't get in by that date, by your birthday, they'll take you off.
Yeah.
They will automatically, they put me back on and I didn't suffer any penalty, but it was a nightmare. You find yourself without any insurance at that period when you're not on. Even though I started preparing and filling out the application before my 60th birthday, but there were so many things that needed, and it didn't go through. And then the government wants you to fax, just email stuff. You have to fax
The
stuff.
other thing to keep in mind is I think sometimes people think because they're working and they have insurance that you don't have to apply. You have to apply even if you're working.
Yeah.
So just make sure you get that in. And then I don't know, at some point Part B kicks in, and I think that's not until you're 65. But even if you're working still at between 64 and a half and 65, make sure that you're applying for your Medicare. Any other tidbits that anybody want to share?
Yeah, Helen,
Yes.
go ahead.
You first, dear. You first.
Oh, okay. I have a loved one who went out before his 65th birthday on disability and did not realize that because he was on disability, he should have applied for Medicare. And it has turned into a full-fledged nightmare because they put him on a penalty status. So if you, for any reason, go stop working and get, disability, you really need to check in with Medicare too and ask them what you should be doing.
Yeah. And
this is Serene. I just learned that the window actually is 3 months in either direction of your 65th birthday. So 3 months before to 3 months after. Otherwise, you're faced with a lifetime penalty.
Lifetime. Oh my God.
Yeah. And you think that because you start 3 months before that, it would go through automatic. No. I think in my case, it was my name was abbreviated at my job. That's what it was. And my name on my Social Security card was different. It was a nightmare.
I can imagine. Ken, what did you say? You have a question, and I saw you put something in the chat.
Yeah, I said I wanted to introduce myself and my financial literacy education company to you ladies. And I'm also a published poet, and I wanted to share a poem that I wrote for ladies. But that's after I give you the information on my company. A dear friend of mine invited me to this group, Linda Carter.
Okay.
Okay, you may know her.
We kind of know her.
Okay. But in any event, this is actually my 40th year in business. I owned a real estate company in South Orange for 26 years as a real estate broker and an appraiser and developer. But in 2008, I closed that business down as a result of the financial banking debacle and opened a company called Working Your Money, teaching financial literacy and introduction to entrepreneurship with children and adults. I'm going to put my website on for you. I also work with a company out of Pittsburgh, my partner, called thinkandprofit.net. What we do is business consulting, taxes for individuals and businesses, as well as immigrants who are coming over and they need to get identification and get paid their wage rather than being cheated because they don't have papers. So we help with all those things. So I just wanted to share that information with you, and have you
Is
guys
your
go to
poem,
my. I'm
is
sorry.
your poem brief? Is your poem brief?
It is brief.
All right, well, let's hear your poem and then we'll go on to, I see some other questions popped up, but go ahead.
Okay, the name of this piece is called Sisters. Sisters, I see your situation and I feel your pain, my sisters, as you struggle for dignity, self-worth, and material gain. Working on backhoes, telephone poles, factory rows, and only God knows how you make ends meet. I mean, I see your situation and feel your pain. Staying up awfully late at night because the children are hungry and need a bite. I honor your courage and willingness to fight the wrongs in life when you know you're right. I see your situation and I feel your pain, my sisters. No glass ceiling can contain your awesome power and eternal light as you bring perpetual new life into the world. Hail, Queen Mother Earth.
Wow. It is, we are phenomenal women. How do we keep it? You know what, though, on a real note, I mean, how many of us grew up in a house with a single mother and we
And
were
how many
poor?
of us are single mothers?
We were poor and didn't even know you were poor because somehow they can take we're saying that make a way out of make some way out of no way. They just make it happen. So
Well,
thank you for that.
this poem is attainable for anybody who's interested. I will leave my email, and if you send me your email, I will send you a copy of the poem.
And did you attend Rutgers, Newark?
I'm sorry?
Did you attend Rutgers, Newark?
Yes, ma'am, I did.
I thought you looked familiar. In another lifetime.
What is your name?
My name is Charlotte. I was friends with Maxine and
Maxine Mitchell?
yeah. Mm-hmm.
Oh, my stars.
In another lifetime.
Indeed.
But you have the same aura, for lack of a better word. You have the same chemistry.
Thank you. Thank you. But I'm particularly interested in sharing information. I've been doing this for a long time as a business professional. There's a lot going on, ladies, and I don't know if there's a gentleman there, but the financial market is in a tremendous metamorphosis, a change. The banking system, the advent of digital currencies. The Federal Reserve has back in 2023, my birthday, July 20th, they launched what was called Fed Now. Go look it up. Fed Now. That was launched by the Federal Reserve Bank, which, by the way, is not a federal agency. It's a private corporation. Go look at that. And since 2009, we have been experiencing this new phenomena called cryptocurrency and digital currency. I hope you guys are familiar with it, because we're in the throes now of a wealth transfer that's taking place. But unfortunately, many in our community aren't plugged in, aren't aware. And so as a result, we're missing a boat that if we don't catch it, it could be a devastating experience going forward. So these are the kinds of things that I teach. And I'm still a licensed real estate broker, although my license is in a referral network. But I've taught real estate for licensees and people who are going through foreclosure. I do counseling with them.
Right.
So these are the services that I provide.
Okay, so you put your link in the chat. So if somebody wants to reach out to Mr. Carter, you have his information. And if you want a copy of his poem, he'll get that to you as well. if you send it to me, Mr. Carter, I'll put it on our Google listserv so all the women can see it.
All right. I'm going.
Let me, somebody's asking, yeah, so yeah, they want the contact information for your website. So make sure you put that in the chats, Mr. Carter. Somebody had asked the question, I don't have the answer. Are you allowed to apply for your Medicare before? I think the person said I'm 63 and can they apply now? Does anybody know?
No.
Yeah, you can't.
No, that's not
can't
an
apply
area.
early?
That's not
No.
it's not an area that I study in, and so I wouldn't
So
advise
You can't
that.
apply early. You
You
can't.
can, you
can't
cannot.
apply early. You won't. You can apply
Oh, you
early.
can.
You will not
How
not
early?
necessarily at 53. I
Okay.
don't remember, but
Yeah.
I think at least
I think it's a few
most.
months before your 65th birthday, and
No,
you'll
No,
get
it's more
med-
than that. It's
can we do
you
it
will
it's
before
more
get
than
then,
that.
Lola? That's the
It's more than
question.
that, but you get a reduced amount
Ah,
forever.
You can
okay.
apply for Social Security at
right.
age 62. You cannot apply
62.
for Medicare
And
until you're 65. It doesn't kick in until 65 and 3 months before you're 65. So two different things. You
That
can
is
get
correct.
your Social
Sorry, thank
Security early. Yes.
All right. Social Security is one thing, but can you apply for Medicare before 64 and 9 months?
I don't think so.
I
No.
don't think
Okay.
so. I think it's 3 months before your 65th birthday or 3 months after.
right.
Yeah.
And you
All
will
right.
But
get
just because you're not eligible for Medicare doesn't mean that if your situation, your financial and your health situation require that you have no help on the medical front, because Medicaid is there that can probably help in situations like that.
And for Medicaid, you have to not have, I just heard this today, you can't have more than 2,000. You have to deplete all your resources down to 2,000. So and that's for like if you need long-term care, if you're in residential, that's when people say you lost everything. And every state is different. At some age, ladies, we need to all be considering. I don't know if anybody on here does elder law. But at some point, we all need to not have any of our assets in our name for that very reason. The risk of that is putting your assets into the name of somebody that you trust. And also, if you put your assets in the name of your son and your son gets sued, then you have a problem. So, as he was talking, I don't know how the rest of you feel. I just find all of this so overwhelming. And, can we
well.
just get old? Can we
Just
just get old and leave me alone? I mean, it's a lot to think about.
Helen,
But if you
Helen,
have things in your name, you're running a risk that you have to lose. God forbid something catastrophic happens to you, you'll have to you can't own anything before the state will kick in to help you. So either way, you're going to find
well,
yourself in a bad situation.
Helen, that's why
Yes.
Mr. Dixon, you met him. So he can be very helpful. I mean, he's the real deal. Just listening to him, I didn't say anything. He's the real deal. So he can help you with that because he'll show you. I know he knows his stuff. Wow, he does.
You're talking about
So
the young man we just had, Mr.
yeah,
Dixon?
yes.
Yes. Yeah.
So
And Michelle was very impressed with him. So yeah.
gosh, he knows the stuff. So he'll help you in that regard in terms of whether or not to have.
Those are things, that's just something for people to be thinking about. I remember having lunch, having dinner. I was the only person there who didn't have children. It was 3 couples and they all had children. And not one of them felt that they had a child that they would trust enough
Wow,
to put their assets. And
that is
that's a shame. That's a shame. But they didn't feel that they didn't feel comfortable with that their children would do right by them,
oh
not
my
spend their
God.
money, not put them in a home. But Lola, you're fortunate, but everybody's not as fortunate as you.
God,
That's right.
And we've all seen, when money becomes involved, people do horrible
wow,
things. And all
wow.
those good relations go out the window. Melinda, did you want to try speaking again? Melinda, you have your hand up again. Melinda?
Unmute yourself. Oh, there she goes.
She uses Zoom
Can you
all
hear
the
me?
time.
Yeah.
Yes?
Yeah.
Go ahead, Melinda.
Great. Sorry about that. Not sure what's going on. So I do agree with you, Ms. Helen. This is all so overwhelming. I do not know what I'm doing, what to do. It is a lot to think about and to consider. I know that I had asked the question, I had posed the question just to refresh everyone's memory. I'm 37, single, no children, no assets, no annuities, no anything. And for someone starting from scratch, I don't know what to do. And I'm sure maybe I'm the only person in this room with that situation, but there are so many people at or around my age who do not know what to do or where to start. We have student loan debt, and we're saying to ourselves, investments, retirements, we know that we need to think about these things. We know that we're gonna, get older. That's the goal. That's hopefully we live well into our centennial years, but we have no money in preparation for that. So what is the easiest thing that we can do right now to get started? I know he said start off with an IUL, but I was researching it as he was talking, and I was saying, okay, this is overwhelming too. What is this? I'm not quite sure what this is. Never even heard of this. So I need something that's simple to where I can get started. I need literally a 101 course, almost explaining this to a fourth grader. I know fourth graders aren't thinking about this, but that is what I need, because right now I'm saying to myself, this is a lot of useful, helpful information, but most of it is going over my head. And if I knew this, and if it was raised to think about money in this way, as opposed to just saying, God will provide, trust God, have faith in God, that is not a retirement plan. But that had been what had been taught. So I'm sort of saying to myself, where do I start today, right now, to get the ball rolling? And I'm not sure. So although I'm grateful for him coming today and speaking with us, for me personally, a lot of what he said went over my head. I'm doing research and typing as he's speaking. And like you said, Ms. Helen, it is overwhelming.
There is
This is what I strongly, strongly recommend, that he is very patient. And even though you're 37, girl, you're young, you might not feel it, but you are. So I encourage that you reach out to him and do a one-on-one, and tell him that you need a lot of hand holding. So he said he has a seminar, whatever, coming up Tuesday. You might need more than an hour. But maybe reach out to him and say, I'm a newbie. All of this is foreign to me. What can I do in preparation before I speak with you, so that it can be very informative for me? Maybe ask him to send you some things that you can read up on, so that you can come to him with questions. But the one thing that I keep telling young people that I didn't do: save, save, save. I don't care if it's $100 a week. Put it away. Don't touch it. And somebody told us that, but somebody told me that too as a young person. I just you have to live with the intention that you might get old. And saving is important that you do. I've just been living life and having fun, so don't do like me. Save, save, save. And I don't even care how small it is. And what Fonnie said, you have some money up in your house. I think we need to all learn from what she talked about this weekend too, because if you think back, Big Mama died. You always knew, check the Bible, check under the mattress. Like, there was always some money in the house somewhere. So, and we don't know what's happening with, like Mr. Carter was saying, there's so much uncertainty and instability. We don't know what's happening. So, you don't want all your money in your house, but we need to be intentional about saving. But Linda, definitely reach out to him and check, and make an appointment with him and let him guide you.
And you always were told, you pay yourself before you pay anybody else. So like 10%, 5%, and it's not money you just put in the account and take it back out. You start off with
like
a
you
savings
forgot
account,
about it,
and then start moving up to investments.
Who is that on the phone that's trying to speak?
Real quick, this is my name's Jay. I've been listening. For those who overwhelmed, this is speaking what they call banking language. Like it's a different language. So all you have to do is just keep exposing yourself to it. And so like right now, it's just like if you went to real estate school, you're gonna be overwhelmed because they're speaking different languages, even though it's English. And this is financial. They didn't teach us this all this language. So it's your first time really hearing it. Don't worry. The more you hear it, and the more you hear it, give it 3-4 months to a year, you'll be like, wow, I get it, because it's a different language, literally. So don't get anxious. Just give yourself time, and it'll all sink in. Start sinking in. And if you ever know about the AI, the GPT chat robots, or any of the chat bots, you can do exactly what you said. You can say, explain annuities to me on the 4th grade level. And then say, certainly. And you can say, well, break it down as if I'm 10 years old. And it will fashion that information and break it down just like that, if that's literally what you want. So the chatbots, GPTs, all of that can help you learn this stuff too, to get familiar. So that's all I wanted to add in.
Thank you. And that's a good point. Like you're not gonna start out swimming right away. You're gonna float before you learn to swim. So that's a good idea, that we become overwhelmed with all of it, but it takes time.
And if I may, Ms. Higgy, so my experience is that my parents were both educators. And so around our Sunday table, they talked about everything but finance. And so as I go to these seminars, and I told Mr. Dixon, I said, young people need to hear this. And so I invited young people as well. And, the point is, just like Jay was just saying, Prater Jay was just saying that, the more you hear it, the more the language becomes comfortable. And you're familiar with it. And the example I like to use too, is I heard this when I was at AT&T, is that when they asked, when President Kennedy was in office, they asked, I forget which one of the kids it was, John F. Kennedy, I guess, the young one. They said, what do you want for Christmas? And he was 6 years old. He said AT&T stock. And so point is, at 6 years old in my house, we weren't talking AT&T stock. And so young people, even though he starts out with retirement, I was thinking, oh, it's going to turn off a lot of young people I invited. But, I'm glad glad they need to hear this, because they need to plan for this retirement and at least know the lingo and know, the attachables versus the non-attachables. And that's what got me when I heard Ken's talk. I said, attachables, what? If somebody going to go after my money, my 401k, and my savings, what? Are you kidding? We're not taught that. And so, the earlier we learn this information, the better. That's my point.
Absolutely.
That's true.
Can
I was
I
watching.
interject for a minute?
Yeah, let me say, I was watching something earlier today. I don't know, a TikTok or something, and it was literally a Black woman school teacher. They were very little, like 1st grade or whatever, and she was teaching them about money, and she put something on one of these platforms, and it just went viral. They don't teach us civics. They don't teach us about banking. They don't teach us about life. And I
But do
do
you
think
guys,
that, there was a time that they did. People did talk to, when you were in school, you did learn how to balance a checkbook. And you heard Fonnie. Fonnie said, what's a check? She don't even have checks. So it's a new generation. But anyway,
does
Mr.
anybody
Carter.
remember PSFS Bank? Do you
Yeah,
remember that growing up?
yeah, the
And like Philadelphia, New Jersey, and you started little savings accounts back then in elementary school. You could open up an
Oh,
account.
no, I don't remember that.
No?
Ladies,
No.
I've got to get off, but I just wanted to share this one tidbit with you all. With respect to banking, if you have bank accounts, you're getting a 0.5% on savings if you're lucky.
Right.
All right. Inflation rate right now is somewhere around 8. Well, the government says 7, but it's higher than that. But so that what inflation does, it eats the buying power of your dollar. So if you sit your dollar into a bank, it's getting worth less each day.
Right.
That's why you have to put it into something that gets worth more each day. That's called investing and growing your money. So if you'll take the time, and you don't have to listen to me, check out what's going on in the banking system today. Google, if you will, how many times that people in all the various banks, especially Wells Fargo, Bank of America, Chase Manhattan Bank, are now, people can't get their money out, and they're getting their money actually taken out of their accounts. And even in one instance, their savings deposit, box, saving deposit box that they lock, which is both private. But the banks are on the way out because digital currency is here to stay.
Oh, now that's a discussion
That's
that needs to
interesting.
be.
That's
Well,
interesting, Mr. Carter, because I have heard, I know that like you can't go into the bank and say, give me all my money. They
no,
will tell you
ma'am.
that there's a maximum that you can get every day, which I think is just crazy, that you can't go in and say, give me. And another point that I heard, I think it was Brother Umar make, is that we give all this money to churches on Sunday. Because I love when he talked about using your life insurance to to borrow from yourself. That is so beautiful. But it made me think of Brother Umar, who said that we go to church on Sunday, put all this money in the pot.
Right.
They put it in a white bank on Monday, and then we go to the bank on Tuesday, and they charge us all this money to borrow money that we just put in the bank. Why
That's
isn't the
exactly
church
right.
keeping the money? Why isn't the church at least using a black bank? So, Melinda, I'm on you, girl. I am twice your age, and all of this is just like, I don't even want to think this hard to understand it, but we have to. And you're young, so you have time to learn all this. It's never too late.
Yeah.
Go ahead,
Well,
Tilthea.
Yeah, I'm trying to
However,
see
it's still hard.
pardon me? You're,
I was saying, Miss Helen, I said that's true. However, it's still so hard.
Well,
Okay, Helen,
it's
Melinda,
not hard. It's not really hard. You
may I
just
just say,
need a strategy, and you need some education. It's not hard. Pursue the education around it. My website there is workingyourmoney.net. Working your money, and
did you
that's
put
what you
it
want to
in?
do. It's on the stream
In the
here.
chat?
It's on the
Okay.
chat.
and
Uh,
Helen, I'm sorry.
So wait a minute. So Melinda, I just wanted to say a couple of things. It really is confusing, and I understand that. Just a couple of resources, just so you can kind of get familiar with the language. The government has a site called www.invest.gov, G-O-V. That's a good place to start. Also, there's an Asian woman on YouTube called Your Girl Rose or something like that. She's very, very basic. And also there's a woman, a little more advanced Black woman called From Lack to Literacy, I think also on YouTube. So just a few things, and definitely if you have any real money, don't put it in the bank. Get you a high yield a bank account. So you're looking at a couple of pennies a month. They will give you 2 or 3 cents, the bank will,
Right.
as opposed to someone that's given 4 and 5%.
Yeah.
Look at a high yield bank account.
Right. But also the first thing to do is to start saving, whatever it is, because you also need emergency fund money, right? Make up your mind, $100 out of paycheck every week or something, and let that start to grow. And then you can start turning it into other investments. That's the key.
Ladies, go to the Federal Reserve website, and you'll see what real money is. And it is not the dollars that you have in your pocket. It's gold and silver. It's always been that way.
Really?
Yes.
I just want to say, if the young lady, Melinda is her name, I'll give you my number. I can break some things down for you where you just have simple questions that I can help you with. I will. And you can meet with the young man who spoke to us today. I would highly recommend that you meet with him. And
So don't say your number out loud, Lola, because it's going to be on the internet. Put it in the chats for her so that everybody doesn't get to see it.
Okay.
Okay.
And Judy just put something.
All right, ladies, I hope I've got to run. I hope you all have put your email in so I can send you the poem.
All right. Thank you, Mr. Carter. Appreciate you for coming by.
Okay, so now how do I get, if they put it in the chat, how do I get their email address?
Working your money.
Yeah. If you send me, you're gonna be, I'm gonna have your email address anyway.
Yes, so they can just do it that way.
Yeah. And then if you want me to post it for everybody, you can send it to me and I will post it for everybody.
That would be a great thing. Yes. I have your email address.
Yes, you do.
Oh,
all right.
All righty. Thank you so much.
Thank you so much. Have a great evening.
Anybody else got anything else? And Melinda, don't feel like you're the only one. Trust me, there are other
Yeah,
people on this
I don't want her
call.
to be discouraged at all. Please come to me.
No,
I'll break it down for you.
she wants,
Right.
well, I'm gonna
No,
come to
not
you
at
too.
all.
Sure, you know, you do have access to me any day. I can't get you to cook. I can at least get you to do that.
That's a good one.
This is good. This is good. I'm gonna stop recording and we can just talk. I know people want to talk a little bit about Fonnie and all that happened this week, and that's what we're gonna do. So on that note, I'll say thank you, ladies, so much for coming, for listening to Mr. Dixon. I encourage that we all become financially healthy. And hopefully, get in a position where we can create some generational wealth. Thank you so much, Michelle, for referring him to When Black Women
Yes,
Gather.
thank
And
you.
anybody on this call who wants to make a presentation, you have a subject that you want to share with us, you have a guest that you want to invite, just say the word. We can make it happen. And we will do that. So on that note, I'm going to stop recording and thank you all again.
Thank you.
If I can find the stop recording buttons. Okay.